Mayuresh Joshi, fund manager at Angel Broking, joins me on the show now. Mayuresh, thanks so much for joining us. It is the day before the monsoon session, Mayuresh. I'm going to connect what's happening in the markets with what's happening in Delhi. A lot of interesting developments, likely a heated session of Parliament. How are the markets, gearing up for that?
Afternoon, Minnie. I think clearly on the domestic front, we've been enumerating three key points. A, how the monsoon itself pans out. B, I think the monsoon session is expected to be volatile in lieu of the political developments that we've witnessed over the past few weeks. And corporate earnings expected to remain subdued. So in specific terms for the monsoon session of Parliament, the key bills that are languishing in front of the Parliament, GST and Land Bill. My personal take is that if there is no developments on these two key bills, I think you'll see the markets correct from the current levels, assuming that it is still going to take time for these bills to get passed and again implemented. So I think the monsoon session is going to be key and pertinent as far as the passage of bills is concerned. But it looks like a very rough ride for the government to probably take these bills through.
Right up. Mayuresh, I'm going to talk about the cement pack because that's where a lot of the pain is today. ACC, very dismal numbers. Ultratech expected to also perform dismally when it comes out with numbers. What's your take? Because there was a time when the markets had given them a thumbs up. Many of these stocks were actually going up. And, I couldn't figure out what was happening. And I was asking the question to many people. What is your sense?
So clearly, Minnie, I think the expectations of the market based on cement companies is that the volume recovery will come sooner than later. B, I think with the kind of fall in raw material prices that you've seen, specifically in the case of imported coal and petcoke, that will provide tailwinds to the EBITDA margins of these companies. And yes, I think the numbers are expected to be subdued for a lot of these cement companies. The realizations have fallen. You take any region, the northern region, the southern region, and probably because of that, I think you're going to see compression when it comes to an EBITDA to ton basis. So I think you're not going to see the offset effect probably take place. However, on a quarter-on-quarter basis, I think the leverage benefit should continue for a lot of these cement guys. So the take of the market is that over the next few quarters, as demand revives, as volume pickup happens, and as utilization levels pick up, the return ratios of these companies will improve as order flows increase from both the infrastructure segment with locked up projects getting unlocked and probably housing orders reviving over the next few quarters. That is probably creating an impetus in terms of expected cement earnings. But clearly, I think Arctic has always been that cement earnings will be poor. But again, I think if you go by this theme and if you presume that a lot of these earnings momentum should come through in the next few quarters, I think on a stock-specific basis, I think cement companies do look attractive. But the biggest caveat is that the recovery cycle has to begin sooner rather than later.
Mayuresh, hold on. We'll come back to you in just a moment. We also have a management online. K Ratings came out with numbers. It is under slight pressure in trade today as Q1 profits witnessed a drop of 34% on higher expenses. D.R. Dogra, MD and CEO K Ratings, joins me on the phone line now. Mr. Dogra, thanks so much for joining us. Do take us through the numbers because the first cut indicates that your other income component was down sharply. And while income and EBITDA profits are down. So take us through this, the fall in profit, the 34% fall in profitability.
Yes. Good afternoon to you as well as to your viewers. I think we have to, look at our numbers. Company like us, which focuses on rating revenue, you have to look at our operating revenues. And if you look at our operating revenues, the rating revenues have gone up from 42 crore to around 48 crore, which is a growth around 13%. Even if you look at total revenues, total operating revenues, they've grown up from total 42.68 crore during quarter ended June 14 to 48.44 crore in the quarter ended June 15, which is a growth of again 13.5%. Against this, we have been able to stem the growth in expenditure to just 5.62% from 24 crore in June 14 quarter to 25.35 crore in June 15 quarter. That shows that operating profit has gone up by around 24% from 18.68 crore in June 14 to 23.09 crore in June 15. Of course, our PAT has gone down, as you rightly said. Our other income has come down from 14.84 crore in June 14 quarter to just 2.92 crore in June 15 quarter. But this is more to do with our policy of rolling over of fixed maturity plans. The tax rules have changed.
So it's a one-off thing, Mr. Dogra. You're saying it's a one-off thing and you will be able to manage the clip of growth both in revenue and profit.
You are right, 100% right, because when we book this income in June 17, you will find that our other income in June 17 quarter
will be higher.
Will go up like this, as if you will say we have done so well in that quarter. So you have to, appraise us from the operating perspective and operating margins. If you look at our operating margins, they have gone up around 4%. And the simple reason is that we have not only done well as far ratings, growth is concerned, but also we have been able to curtail expenses to a large extent.
Sure, Mr. Dogra, we'll leave it there. Thanks so much for joining us. So the picture, a little mixed, in fact, looking pretty good, and the markets perhaps not reading it right out there. But you can see the flash on your screen. Now, the story that we had brought to you on Friday, the fact that FDI limits might stay and the subcaps might stay in defense and banks. There is a clarification from the Commerce Ministry that the sublimit on FPI in defense and FI and private banks to stay. Mayuresh, you're with us. When the news came that there is going to be a composite cap, I think the segment that buzzed the most was private banking. After the clarification, we've not seen much of a correction, but how are you reading this piece of news?
So really, I think nothing changed. I think the speculative part of the expected increase in FIs, you probably saw some positions getting built, but nothing really changed when it comes to the larger pack. So I think our take on the larger private sector banks still remains the same. It will be driven more or less with how the earnings trajectory pan out for all these banks, how their asset quality holds up, and how their lending book in terms of both credit advances as well as how their credit costs are curtailed. To that extent, I think with capital adequacy in mind, specifically for the larger private players, I think the return ratios should be quite stupendous over the next few quarters. So I think we're still maintaining our positive stance on the private sector banks, where we believe the earnings CAGR over the next 2 years can be quite stupendous. So I think if you leave aside this issue now, I think it will all boil down to how earnings match out and pan out. And in our opinion, I think the earnings should be quite reasonable over the next few quarters. So I think we are maintaining a positive bias on the larger private space, names like an Axis, ICICI, Yes Bank.
Infosys comes out with numbers. Is that likely to be a positive trigger if there is an optimistic set of numbers over there, Mayuresh?
So I think no great set of numbers expected, generally from the IT pack, seeing the trend with what TCS has done. Infosys is expected to post a very muted quarter this time round. 2.7% in terms of a quarter-on-quarter growth is what you've got in dollar terms. But clearly I think the management focus is on a much larger canvas. So I think by 2020 expecting revenues to the tune of $20 billion, setting up cash of close to $5.2 billion, that augurs well in terms of organic and inorganic acquisitions for Infosys. And clearly I think the impact on EBITDA will be seen with wage hikes coming through. And the expected tailwinds that one really expects from a stable currency, I think more or less gets offsetted with the kind of wage hikes and the increase in SME spends that you're probably witnessing. So I think EBITDA will get compressed this quarter around. The EBITDA margins will get compressed as well. But again, clearly, with cost optimization efforts going through with client mining activities that Mr. Sikka has initiated upon, and clearly in terms of utilization levels going up from the current 78.6% that we're looking, and valuations extremely attractive at 15.2 times. I think it becomes a very compelling case for long-term investors. So I think post results, if the stock does correct, I think it becomes a very good buying opportunity for long-term investors.
Right, Mayuresh, we leave it over there. Thanks so much for joining us. That's a quick take on the buzzing sectors in the market and where a lot of the focus has been. Up next, focus on the monsoon session. Neerja Chaudhary, political commentator and columnist, will be joining us. We'll also get you views from what the government has said. The Prime Minister, Urban Development Minister, all of them have spoken in New Delhi ahead. There's been a lot of meetings, all-party meetings. We'll come back and talk to you about that.